Hello, guys. This week we're gonna talk about pretty much the last topic of the semester. So I'm saying it's pretty much because for this topic we're gonna talk about venture capital, and then for the next one I'm gonna briefly talk about IPO. So these things will be the last content we talk about in this semester. So for venture capital, we already said last time that it is a subclass of private equity, right? So, I mean, you can think about that as a special case of private equity. And the purpose of the venture capital is basically to provide capital to new, young, and growing ventures, right? The structure of the venture capital is actually similar to the structure of a PE, but their purposes and the provision of the financing are totally different, but the basic structure is similar, and we will go back to it in a second. And basically, new ventures possess characteristics that make it extremely difficult to attract financing, right? I mean, the typical way to think about that is if you are a startup firm, right? You don't have prior history of performance, right? So how are you going to convince the bank to lend you money, right? I mean, you're probably engaging in a very, very risky project. Banks themselves don't even know whether the project will succeed or not, right? Then how are you going to convince the bank that the company will be able to pay back the loan? Right? So then in that case, it is very difficult to raise financing from traditional channels, right? For example, from creditors, from banks, right? So that's why the venture capital plays an important role here, right? They're providing capital, right, to kind of take up the role a bank cannot possibly fill, right? So that's why, because of this very special nature of startup firms, right? First of all, they have no prior history. Second of all, the valuation of their company or the valuation of their business is extremely difficult, right? So because of these features, their financing cannot take place in mainstream investment markets. And then they are considered an alternative asset class, right? This point I discussed last time as well, right? They are considered alternative asset class because they are not like traditional stocks, bonds, or options, right? They are not trade. I mean, they cannot be traded in the investment market. And what is venture capital exactly, right? It's a subclass of private equity. And typically, venture capital provides financing for startup firms, right? These startup firms, they require substantial capital to expand, and they cannot usually get it from conventional sources. So the size of the VC market is actually very important in recent years, right? Considering the rising of the high tech industry, both in US and China, right? And also in Europe, right? In Europe as well, right? So how big are these venture capital firms in China? Over the 15 years, the country has spawned a third of the world's unicorns, right? Unicorns are referring to startups valued at USD 1 billion and above. And by the second quarter of 2018, Chinese startup firms, they accounted for 47% of the world's venture capital volume. Now, this was like the peak of Chinese venture capital financing. But after that, China went through the capital winter, right? So because many of the startup firms venture capital invested failed, or for whatever reason venture capitalist firms are no longer are no longer capable of providing large amounts of financing to those startup firms. Right? So that's why the kind of increasing volume the VC business has slowed down after 2018. Of course, especially in this COVID season year, the VC capital further slowed down. But in general, it increasingly play an important role in the general macroeconomy. So in the venture capital cycle, so meaning that venture capital cycle typically refers to the initial financing of startup firms and then to the time when the venture capitalist firm exit from the firm. So in this cycle, entrepreneurs, right? We refer to startup firms as entrepreneurs, right? There are many ideas that require substantial capital to implement, but lack the funds, right? And usually such entrepreneurial projects lack tangible assets, right? So, and then these projects expect several years of negative earnings and have uncertain prospects. So, as a result, it is difficult to attract funding to these projects. And that's why venture capital funds, they are one type of solution to the funding problem of these firms, right? Because again, these firms, they are very difficult to attract traditional financing. They might experience years of negative earnings, right? Because we know that in order to build a public firm, in order to build a mature firm, in many industry, you have to invest a lot in the as the front end, right? For example, Uber, right? Uber has been experiencing negative earnings for many years before it became a very large private company that offers the ride sharing services, right? I mean, I think even before the fifth or sixth round, it was having negative earnings, right, in many years. That's why for entrepreneur projects, it is actually not very uncommon to have negative earnings or consecutive years of negative earnings before it finally went to IPO. And when venture capital exited from this cycle, they have this 262 rule, which says that 20% of investment will be winners, 60% will be leaving dead, meaning that they will continue to operate, but it will potentially return just enough to justify ongoing monitoring costs. Or meaning those monitoring costs are typically paid by venture capital firms, right? And another 20% will cease to exist, right? Meaning that they will fail. And in general, let's formalize the reason why we need venture capital. So that we can understand the role of venture capital or private equity more clearly. So basically, venture capital exists to kind of solve the moral hazard or agency problems in those startup firms, right? And these companies also have this information asymmetry problem when they are trying to attract financing from other firms, right? And then we have this classical capital gap problem, which the capital they need cannot be satisfied by traditional investment vehicles, right? That's why venture capital can step in and provide the financing. And they are typically intermediaries, right? They are intermediary in the sense of venture capitalists, they raise financing from limited partners, right? Because again, they are like private equity. That's why they raise financing from limited partners, right? And then they invest on behalf of limited partners, right? And they invest in startup firms. And as we know, the types of firms that venture capitals finance have high risk, right? But theoretically, we know that high risk could be rewarded with high returns, right? So then what is the problem here? The problem is that high returns to investors actually means a large ownership fraction of the venture is transferred to the investor, right? You need to deliver high return. And then this presents numerous other problems that discourage investors. So for example, first of all, here is the moral hazard problem. So what is the moral hazard problem? It is the tendency to take risks or make value destroying decisions because the costs that are incurred are not felt by the risk-taking decision-making party. So essentially, investors, when they contribute financing, they don't really know what's going on, right? I mean, they don't know what kind of cost the startup firms are taking. And this moral hazard problem, it can also occur when a party is unable to observe or verify a counterparty's behavior after the contract is put in place. Right? You don't know. I mean, you don't know what kind of investment choices, what kind of projects those other firms are doing. Right? It's almost like insurance, right? After the person, I mean, after person bought your insurance policy, you don't really know what he is doing, right? You don't observe the insurer's post purchase behavior, right? For example, the owners have no way of knowing the effort of the agents and managers, right? They only observe the final output of performance, right? That's why even if the investors they own large amounts of shares in the startup firm, I mean, this does no good to them, right? Because they don't actually observe what owners are doing because it's very technical business, right? And also it's because it's highly uncertain. So entrepreneurial firms they may be subject to even higher moral hazard risk here, right? Because these firms they might be even harder. It might be even harder to observe their actions after financing. That's why this leads investors to demand high rates of return on their capital, and it makes it harder to attract funding to the firm, right? Because it's very risky, and also investors cannot observe um, the action of the VC firms. Right? The second problem with these startup firms is the information asymmetry problem. I mean, it is related to the moral hazard problem, but it's a different problem. So the problem here is called adverse selection. Adverse selection lies in the key issue of this information asymmetry. Okay, the second issue with startup firms is what we call information asymmetry. And what is this information asymmetry? The underlying issue here is adverse selection. So adverse selection is a different problem from moral hazard. Basically, adverse selection arises due to one party being unable to observe or verify a counterparty's preferences and abilities prior to making an agreement. But remember, this is prior to making an agreement. So George Akerlof has this Lemons model that talks about the adverse selection or models this adverse selection problem. And this actually got him the Nobel Prize. Well, basically, the model illustrates the dynamics of this problem in the used car market, where the quality of the second-hand car is variable. So basically, in this market, you have good car, you have bad car, right? So, but buyers, they don't know, right? When they go to the second-hand market, they don't know which car is a good car, what cars are bad car. Therefore, there's an information symmetry between the seller and the buyer, right? So there's potential information symmetry here. Now, the implication is that because the buyer don't know what cars are good cars, what cars are bad cars, right? So then they're gonna assume a probability distribution of the good car and bad car, right? They're gonna assign a probability of good car and bad car, right? So in that case, the expected price they're willing to pay will be lower than the good car. Well, will be lower than the value of the good car, will be higher than the value of the bad car, right? Because they're going to do an expected value. So in that case, you can see good car sellers, they're unwilling to sell the car anymore, right? Because I mean, what they receive is something below the value of the car. But bad car sellers, so bad car sellers, they're willing to accept this offer because the buyer is offering more than the true value of the. Right? So now you can see if there's no inspection, no warranties, then the buyer don't know the true quality of the car. I mean, the buyer just know the average quality of the car, and the seller on the other hand knows the true quality of the car, right? So in that case, market price will reflect the average quality of the bad cars and good cars, right? Because the buyers will do the Bayesian dating, so but buyer will assume any car he encounters has the average quality of the market because he himself cannot distinguish between a good car and a bad car. And in our case, the sellers with good cars will withdraw from the market, right? Like we said, because they are receiving less than the true value of the good car. Yeah. And this pushes the average quality and the price down even further. Right? So in our case, at the end of the day, in the limit, the market will finally break down, meaning that there will be no good car sellers there. There will be all bad car sellers there. Right? So this is the implication of this information asymmetry. So to apply this concept in the startup or VC financing case, entrepreneurs, they know more about risk and return of their projects than external investor. Right? As an external investor, because they cannot distinguish between good project and bad project, good firm or bad firm, right? They can just assume that every firm they're going to invest in has the average quality on the market. And entrepreneurs, they actually know more than their products, than outsiders, right? They have technical expertise. So in our case, even if entrepreneurs have good projects, right? Because the outside investors, you have this information asymmetry there. That's why they cannot distinguish between good project and bad project ex ante. Therefore, they have to assume that any project they're going to invest in has the average quality of the market, of the project that's on the market. So in our case, they won't be willing to pay for those projects that are truly good, right? And then they turn out to be over-invest in those projects that are bad, right? This is an inefficient outcome. And this inefficient outcome is coming from this wide information gap that deters investors because of the Lemos problem, or because of the information asymmetry problem. So because of issues, the challenge of insufficient capital for young new firms is known as the capital gap, right? Because VC firms, they're not willing to contribute. So like I said, there is a challenge of insufficient capital for young and new firms, right? Startup firms. And these firms are often also initially too small to be financed by the capital market, right? They're very small, right? I mean, compared to their public counterparts, they're too small to be financed by the public market. And also, they require too much capital to be financed by the individual savings and are too risky to be financed by banks, right? That's why traditional investment vehicles cannot afford to invest, right? For example, for banks, they don't have the expertise to tell good projects from bad projects, right? So that's why it became a problem for them to invest in those startup firms. And meanwhile, the startup firms are too risky for banks, right? You never know whether the firm will be successful or not. So, and another question is, even if they could be large enough, they still have problems, right? For example, information symmetry and agency problem that we just talked about, right? Agency problem is the moral hazard problem that we just mentioned. So then, in that case, who can bridge this information gap, or sorry, who can bridge this capital gap? So can retail and institutional investing in the public capital market do it? Because these firms, right, they are subject to moral hazard and information problems. Even those retail and institutional investors, they usually do not have the time, resources, or expertise to overcome these problems, right? Because, I mean, in order to resolve this issue, you have to be really know about the businesses the startup firms are doing, right? You also have to kind of monitor closely about the project, right? You have to make sure that the startup firms, when they get your financing, they commit to the investment, right? So they also need to be aware that the startup firms, they are really diligent, right, in maximizing the capital provider's wealth, right? So in our case, retail and institutional investors, they probably cannot invest in those startup firms as well, right? Because they don't have the time, resources, or expertise of doing so, right? And on the other hand, banks could do so, but in many countries, banks are not permitted to hold equity or limited amount of equity in their ownership stake. Yeah, this is one problem. Second, same thing with banks, right? Banks do not have the skills or expertise to work with firms with a lot of intangibles. So in general, financial economists argue that setting up private equity or venture capital funds as intermediaries helps reduce some of these problems, right? I mean, this is the advantage of, I mean, this is venture capital's advantage of offering the financing to those highly risky, highly uncertain business of startup firms. So the venture capitalists, they overcome such problems in a number of ways. They have intense scrutiny before capital is provided, right? They intensely scrutinize the startup firms before the capital is provided, right? So this prevents the information symmetry or reduces the information symmetry. And after the capital is provided, they have intense monitoring, right? They intensely monitor the startup firms to make sure the firm managers are maximizing the value of the investment. This prevents the moral hazard problem or the agency problem. And this scrutiny and monitoring actually takes many forms, right? So this makes sure these problems are minimized. In general, there are two kinds of financing private firms or startup firms they can get. One is the equity finance, the other is the debt finance. And for the equity finance, there are three stages. First stage, it is called bootstrapping. Second stage is called angel investor and seed capitalist stage. Right? Finally, expansion stage. This is when the venture capitalists invest in the private firms. And let's look at equity financing first. This is the equity financing rounds over the early life of a company. So the first round is called seed round. This is basically raising financing in order to prove a concept or qualify for startup capital. Right? The startup firms, the entrepreneurs, they have to prove that their idea is worth investing. The typical amount is 25,000 to 500,000. And the players there are usually individual angels, angel groups, or early stage venture capitalists. Right? And the second round is called startup rounds, right? So this round completes product development and initial marketing. Right? And the typical amount raised in this round is 500,000 to 300, to 3 million, right? So 500,000 to 3 million. And then the players there are basically selected individual angel investor. So an angel or a group of angel investors, and also some early stage venture capitalists. Right? So again, these two stages are considered early stage in the sense of you don't see lots of venture capitalists involved in that process. Right? You only see individual angel investors and early stage venture capitalists in those two stages. The third round is called the first round, the first financing round. So this is when the firm want to initiate full-scale manufacturing and sales, right? Because the idea has been proven, right? The product has been developed, and you can see the typical amount has been increased, right? Now, starting from this round, venture capitalists will be involved from this round on, right? And then you have second round where the firm is trying to raise the working capital for initial business expansion. And the players there are venture capitalists and the private placement firms, right? And in the third round, the firm is trying to raise expansion capital to achieve break even, right? They need to expand. So in that case, the players are typically venture capitalists and the private placement firms, right? So private place firm, so what is private placement? Private placement is usually the way that private firms is using to raise financing. Right? And we also have bridge round, right? Bridge rounds usually there are two ways to look at this bridge financing or bridge round. Bridge round is in between the formal financing round. Right? Let's say you have a time gap between first and second round. So you don't want to do the second round, but actually you have used up the first round. Now you can do a bridge financing, right? To help you transit to the second round. Now you also have a bridge financing from, let's say, the final formal financing round into IPO, right? You can have a bridge round there as well. So basically, a bridge finance is between the formal financing rounds. And then, of course, you can see the amount is also not very high, right? And the participants there are mezzanine financing firms and private place firm and investment bankers, because this is already, I mean, the final milestone, right? The startup firms have to cross in order to go public. But of course, if we are talking about the bridge financing between each form of financing rounds, then of course venture capitalists are involved in those bridge financing rounds. So let's talk about the three major stages. The first stage is called bootstrapping, right? So what is bootstrapping? Bootstrapping is basically testing your initial idea. Right? The entrepreneur, they start a company with little capital, right? Relying on money other than outside investments. And the definition of bootstrapping is that an individual is said to be bootstrapping when they attempt to fund and build a company from personal finances or the operating revenues of the new company. Right? So this is really the early stage of the venture capital finance, right? And at that stage, startup firms will try to use internal equity, like own money, savings, credit cards, personal loans, family members. And this is often a must before any other form of finance, right? Because this is used to prove a simple idea. You need to prove to the venture capitalists that this idea can work, right? In order to get financing from them. So there is a survey who find that bootstrapping contributes to about 31% of all forms of finance. And the median startup capital, it's only about like $10,000. So you may wonder, right? Is it too late for the venture capitalists to step in, right? Because in this table we see that after the first of two stages, right? Then the kind of more venture capitalists will step in. But there are some problem with startup firms obtaining external funds too early. All right, for example, this creates incentive to spend, expand, and squander, right? So if you give the money too early, then the startup firms have the incentive to spend, expand, and kind of waste the money. Right? Second, slower start is often a safer start, right? Because you can make sure that your idea works, right? Make sure that there's a higher chance of success, right? So, and also if you start too early, there's no opportunity for correcting errors or poor decision, right? And in that case, and also venture capitalists are not that patient, right? I mean, they will not allow you to kind of try an error or experimental idea, right? They want to make sure the projects they invest in are pretty good, right? Have a pretty good chance of surviving. The kind of average number of years they want to exit from the startup firms from the day that you're investing is about 5 years, right? And also, if you start too early, the outside investors can hinder the entrepreneur, right? Because I mean, if you put money too early, then the outside investors might be very impatient, right? They want to get a return as soon as possible. But now, if they invest in too early, then the entrepreneur has the greater pressure of having to deliver good performance, right? Which is impossible for the early years of a startup firm. Yeah? That's why the first two rounds helps the entrepreneur to focus on the initial idea they work on, right? To insulate them from short-term pressure. So also investors, they often prefer the safe proven routes learned before previous investment, right? So they are risk averse. But entrepreneur, they prefer experimental try and fix approach. That's why you don't want to give money, you don't want to raise outside investors money to the entrepreneur too early, because entrepreneur, when they use the money, they might need to try it, right? I mean, maybe the first try is a failure, the second try is a failure. Until you try the fourth time, then that might be a success. So that's why you don't want to give the money. I mean, you don't want to give the outside investors money too early, because this also creates pressure for the entrepreneur. So that's why the first two rounds are like a testing round, right? So by bootstrapping, the entrepreneur can actually ensure very high returns or very high chance of success. On the other hand, from the VC side, VCs will also not want too much ownership at the early stage. Right? Now, in that case, because you invest if you invest a lot in the early stages, right, then the entrepreneur has little incentive right? Because they have less personal wealth involved. That's why they have little incentive in kind of improving the performance of the or improving the performance of the company, right? So this is kind of idea. And the second stage is the angel investment stage, right? Basically, professional investors, they invest with their own funds. And these investors, they are often wealthy individuals. They have a lot of experience, right? For example, they include investment bankers, lawyers, retired CEO, and retired scientists, engineers. Right? And their investment objective in the second round is they want to reap the initial high returns by getting in early. And they want to reap returns from value-adding activities, right? And then they help prepare the company for venture capital funding, right? This is their investment objective. And the second stage, for example, for angel investors, their activity is around 12 billion in 2007, right? And the number of investors, it's about 140,000 individuals, right? And the acceptance rate is about 10 to 20% of all proposed deals, right? It's like the startup firms, the entrepreneur go to angel investor to propose their projects, right? But there's only like 10 to 20 passing rate. Most prominent industry include healthcare, software, and biotech. Right? And for the second stage, angel investor, the size of investment is from 50,000 to 100,000, and the investment horizon, the minimum is 7 years. Right? So from 7 years to time of listing or time of sale. Right? So one of the exit options for venture capitalists is to sell the startup firm to another firm. And the average horizon is like 12 years, right? And for those angel investors, the portfolio, they often have less than 5 firms. And the key investment philosophy of these angel investing is that they were highly involved in those startup firms, in the development of startup firm, in the operations of startup firm. And then they will do formal screening and selectivity procedure. They will screen those projects carefully. And also they maintain strong financial resources, right? They have deeper pockets, right? This meaning that they have lots of money, right? So this allow them to diversify or provide continuous funding to avoid dilution of ownership. Right? This is second stage. Finally, we have the expansion stage where many venture capitalists will be involved, right? This stage, the purpose is to raise capital and maintain relationship with investors, select and monitor investments, and finally exit, right? So in this stage, there will be flow of funds from VC and private equity investments. This is the third stage. Now, this is so much for the equity finance. For the debt finance, you also have different sources, right? For example, bank loans, right? Which include overdrafts, commitments, term loans, etc. Right? No, debt finance still plays a role. Bank finance still plays a role. They are not just the majority of the financing. Right? So they contribute to about 30% of all the funding. And it is difficult to obtain for startup firms because banks, they require stable cash flows, right? They also need collaterals in the form of tangible assets, right? That's why they're typically very hard for startup firms who are typically at the initial stages to get it. And also, like for many startup firms, like we mentioned, they have moral hazard and adverse selection problem, right? For example, borrowers, they have different risk appetite to lenders, right? Because of this moral hazard problem. And adverse selection problem as well, right? So there will be substantial information acquisition cost for the banks because they don't know the nature of the businesses that startup firms have, right? And the outcome is that there will be credit rationing, meaning that banks will try to reduce their credit supply, will be hesitant in lending to the startup firms. And there are also other forms, right? You can other forms of debt financing, they're suitable to later stage bridge capital firms. For example, mezzanine funds, right? So mezzanine funds, they provide debt financing combined with equity component. And that is often in the form of unsecured long-term and less than senior rank instruments, right? They're usually unsecured debt, which is by definition more risky. And startup firms, they can also borrow from the venture lending. Right? So venture lending means that venture capitalists, they also provide debt financing with some warrant component. And they often provide small debt amount that allows the firm to continue to operate until the next equity funding round. And again, similar to bank lending, this requires the backing or guarantee of existing venture capitalists, right? So this is like the existing venture capitalists, even if the firm does not have like assets to be used as collateral, at least existing venture capitalists who actually holding stakes, hold ownership, or who have invested in this startup firm, they can use their reputation or guarantee that the firm will be a success. The firm will deliver success, right? So that it will be easier for them to borrow. So next, let's look at VC fundraising process. So overall, the process of fundraising and the fund structuring is a complex procedure, a complex process. And VCs, they invest in risky firms with moral hazard information problems, right? Like we just mentioned. And investors are typically like limited partners of these VC funds, right? They are actually investing in investors, right? Because they put money in the VC and the VC invests on behalf of them. So here, the role of VC structure is important, right? Because the structure will affect the entrepreneur seeking to raise funds, right? And this also affects the behavior of venture capitalists toward entrepreneur firm. So in general, the structuring of private equity funds, they can be understood as a response to the uncertain environment with many information gaps, right? And this private equity structure or VC capital structure, remember VC is a special case of private equity, right? These structures have developed a variety of mechanisms to ensure that value is maximized. Right? So one way to ensure that VC delivers high return is that they give GP, the general partner who's responsible for investing, they give them higher performance fee, right? For example, VCs. So here, VCs are kind of basically general partners, right? We refer GPs as venture capitalists, right? They typically receive from 20 to 30% of the profit. So now, what is the capital inflow into the VC market, right? What determines the capital inflow into the VC market? So, I mean, this is the first question. The second question, what determines the capital inflow into a fund, right? Why do you choose this fund, not that fund, right? So here we're gonna first talk about the determinants, then we talk about the importance of reputation in this VC industry. First of all, the determinants has two components, right? One is the supply side factors, the other is the demand side factors. Supply side factors include the factors that are related to the availability of funds earmarked to VCP investments. So the availability of those kind of funding, or those kind of financing. So for example, we are looking at like financing or kind of money from pension funds, insurance funds, endowment funds, wealthy individual governments, right? They are all potential contributors of the financing. They're typical contributors of financing to the VC funds, right? Now, why do institutional investors invest in VCP? Right? This is because institutional investors, they're also looking for investment opportunity or alternative asset classes that promise high potential returns. So, but most importantly, they offer valuable diversification opportunity when combined with traditional assets, right? Because they are, maybe the traditional assets are not, because one way to think about that is traditional assets, they're usually in traditional industry, right? But VC startup firms, they're usually in new industry, right? So then the combination of traditional industry investments and new industry investments, becomes a good diversification strategy. Right? And other supply side factors include capital gain tax, right, which are typically lower than income tax, right? And capital gain tax also, it's because institutional investors, they are tax exempt or pay lower tax, right? So this also motivates those institutional investors to invest in VCP funds, right? Because what they get is capital gain, right? And then capital gains, they are taxed at a lower rate. And also, there is the clarification of the prudent man rule. So in 1979, the US government ruled that a small allocation into venture capital funds was not contrary to the rule, right? So starting from that time, different institutional investors and even government, right, they're trying to allocate their investment into VC funds, right? And also the money can come from compulsory or incentivized pension contribution, right? Because pension funds, they also try to maximize the return. And another incentive here is that when you invest in VC, when you invest in VC or when the VC funds invest in the startup firms, right? There's usually a good exit route, right? For example, you can sell the startup firm to another firm, right? And then lock in a profit. You can also push the company to go IPO, right? Which in which case you can actually get a much higher profit, right? So a good performance of the public market, meaning let's say the market price, right? Whether it's a bull market or it's a bear market. If it's a bull market, this actually encourages the exit route for VCP firms, for VCP investments, right? Now, in turn, because investing in those VCP has a good exit route, meaning you can earn handsome profits, right? This in turn encourages the kind of money inflow into the VC market, right? And also, this is the demand side factor, right? Demand side factors also include those macro, like market level factors, like economic growth, capital gain tax, R&D tax incentive, right? Because many of these startup firms, they are investing in the R&D projects, right? And then in that case, they can get R&D tax credit. And in general, the supply curve is much more elastic. Much more elastic, meaning they are kind of more kind of changeable, right, when the market changes, right? But demand side factor is not that much. Right? Now, in terms of the demand side, there's also a fund level demand side factors. So because there are many VC funds, right? I mean, of course, you cannot, because there are new funds, there are older funds, right? Of course, not every fund is same. So a newly established fund, it's like a startup fund, right? So, I mean, they have not invested in other firms as well, right? So they also need to build their reputation from scratch, right? That's why if you are a newly established fund, it will be incredibly difficult to raise funds. And you need to overcome substantial agency costs and information asymmetry, right? And also you need to build expertise and network, right? In this industry, networking is very important because you can see the reputation here is very important, right? Because I mean, if I'm the investor, I'm faced with two funds, right? One with established success, the other with nothing prior, right? So why should I invest in this new fund, right? Well, I will be just investing in this established fund, right? And the other important factor here is that because there's no external market to trade a VC fund, therefore reputation is very critical in fundraising. Now you need to rely on the reputation to attract investors' financing, right? So investors in the VC, in venture capital, they are hypersensitive to performance, right? So if you are a VC fund that have held larger stakes in firms that have successfully gone public, then you will have an easy job. You have a good time raising financing for investors. Now you will also be able to raise larger funds, right? Because you have reputation, right? Investors know that you'll be successful, right? You'll be earn high profits. Therefore, investors will be earn good returns as well. Reputation in terms of the age and size is also an important factor, right? Because practice makes perfect, right? So this is the relation between the internal rate of return of a VC fund and the sequence number, right? Sequence number basically tells you whether it's the first, the second, third, or like 10th or 11th fund, right? When the sequence number is higher, that typically means the fund, that typically means the venture capitalist has more experience, right? And you can see from the graph, their return is also higher, right? Because they have more experience. That's why the first-time funds, they have significant challenges here, right? They have significant challenges in terms of raising financing, right? Investors, they are reluctant to invest in a unproven team, right? So in our case, this kind of challenge for those first-time funds, it could be addressed in several ways, right? First of all, you can identify investors who are not purely motivated by returns, right? So in that case, there are some investors who can be tolerant of some failures, right? So then they'll be willing to contribute the money to you. And also you need to establish alliance with existing institution, right? To kind of share the risk. And also you need to recruit a leading investor or special limited partner. You know? So this special limited partner, it is more friendly. He or she is also more committed to contributing their money to your funds. Right? Now let's talk about the structure of the VC fund. Right? As we said earlier, VC is a subclass of a private equity. Right? Therefore, they have the similar structure of a private equity. Right? So they include general partners who are venture capitalists, right? And then those venture capitalists are responsible for day-to-day management of the funds. They also invest a small amount of their own capital, right? And for first-time funds, the established funds, the invested amount could be larger, right? So this is the general partner who are actually venture capitalists who are responsible for monitoring the firms, for example. You also have limited partners, right? Limited partners are those partners who actually put the money into the VC fund, right? They put most of the money into a VC fund. They typically include wealthy families, right? Pension funds and endowments, right? These are limited partners. So initial investors or initial LPs in the private equity fund, they're anxious to avoid opportunistic behavior by the general partner, right? And investors, they have liability limited to the extent of capital they provide, right? That's why they want to reduce their losses. That's why the liability, they have a limited liability, right? So even if the VC fund is broke, right? They don't have to put. I mean, they don't have to put additional money to kind of pay to the other investors, right? But the limited partners, they cannot be involved in the day-to-day management of the firm. Right? Otherwise, they lose their limited liability status. Therefore, the limited partnership structure for venture capital investing is a crucial mechanism for limiting the behavior of venture capitalists, right? To make sure that the venture capitalists are maximizing the value of the limited partners, right? Limited partners, they are delegating their rights to the general partner, right? I mean, you can think about the limited partner, they are shareholders, right? But the general partner, they are managers. So who are GPs, right? GPs are general partners who are responsible for the day-to-day management of the firm and have limited liability, right? And the general partners, they are responsible for oversight mechanisms found in corporation. So they have oversight mechanism, but these oversight mechanism, they don't include board of directors. They don't have a market for corporate control, right? They don't have outside shareholder, right? So that's why these oversight mechanisms are not in those limited partnerships. But instead, the protection mechanism, it includes a series of contractual provisions and covenants that govern the fundraising process and the governance of the partnership. Right? You don't have a big board, but instead you have a contractual obligation. So, and also there's no liquid market for partnership interests, right? So therefore, the limited partners, the LPs, are frequently restricted from selling partnership interest, right? This is to make sure that limited partnership, they have incentive to commit their capital into the firm, into the partnership. So therefore, the primary remedy for limited partners, right, if anything goes wrong, if VC fund is broke, is they can take legal action triggered by the violation of covenants. Right? If let's say the VC fund is broke, right, meaning that the limited partners' money cannot be claimed back. In that case, there will be a violation of covenants, right? Then there will be legal disputes. And how about the cash flow schedule? Right? When do LPs receive money? Right? So basically, LPs has a commitment of their money to the fund, right? The commitment refers to the maximum amount of capital that the individual LP agrees to invest in a fund. And the commitment generally includes management fees, right? As well as other fund expenses. But LPs, they disperse committed capital in stages, not at once. Right? Because they want to make sure the GPs, as their agents, they are performing well. They are trying hard to maximize the return of the fund, right? And relatively large and early payments from the LPs, they're inefficient because I mean those money, they will not be necessary until later stage, right? So there you have large of cash sleeping there, right? So in that case, it is not efficient because those LPs, they can use those cash to invest elsewhere. And if they let those cash waiting to be invested or just sleep there, just sleep on the balance sheet, right? This will depress the fund's overall return. Right? Then instead, they will try to provide those commitments, right, in different stages, right? And then they can invest those commitments elsewhere while they are waiting for the later stage, right? As a result, just-in-time drawdowns of capital as needed have become the norm, right? So they will transfer those commitments, right, when it's needed, and not like well before the time. The compensation structure for the GPs is there's a management fee, right? This is a management fee charged by the GP to the LP. And the management fees in the private equity fund typically range from 1.5% to 2.5% of committed capital, right? Depending on the type and size of the fund, right? And then this fee structure differs from that of a mutual fund managers, right? In mutual fund managers, the mutual fund manager, they typically invest in public markets, right? And their management fee is only like 1% or even less than 1%. You also have a variable component, which is carry interest, right? We talked about last time, carry interest. Carry interest, basically GP's share in the profits of a private equity fund, right? Sometimes a fund must return the capital given to it by the LP before the GPs can share in the profits of the fund, right? And typically the GP will earn 20% of the net profits as the carry interest, right? It's like the performance fee. And some successful firms, they might receive, let's say, 25 to 30%. Right? And in many cases, many funds actually require repayment of management fees from investment proceeds before the GPs can receive any carry. No? This is the typical rule. So, and then this is the kind of performance structure, right? Now, when the VCs exit, when the investment exited, funds are distributed back to the LPs, right? Because remember, LP committed lots of capital into this fund. Right? In our case, the limited partnership agreement specifies how and when these distributions take place. Typically, the contributions from LPs are like 90% or even 95, 99%. In this agreement, the timing and the form of distribution, whether it's cash or security, will also be defined. And then this includes clawback provision, right, which give LPs the right to reclaim a portion of carry interest disbursements to a GP for early profitable investments if there are significant losses from later investment in your portfolio. Right? So this is, I mean, this is like this is, I mean, this is like if you have other if you have other investment that actually fail, that have losses, right? You can actually transfer between the portfolio, right? I mean, it's like you have two investment, right? One loss, one profit, right? You can kind of LPs might actually claim more from the successful investment, right? Because they kind of lose in the failing investment. Right? So there is a kind of transfer here. So the compensation of venture capitalists, there are two ways to explain it, right? One is the learning story, the other is the signaling story. So in general, like we say, right? Management fee and plus the carry interest. So management fee is like the fixed component. The carry interest is like the variable component. And this variable component varies with performance. It also promotes alignment of interest between LPs and GPs, right? It induces the effort on the GP side, right? And also, we can measure the pay performance sensitivity, right? Is to measure how the pay covariates with performance, right? I mean, it's like how strong the incentive GP should have, right, when investing. So so first of all, if we have the learning story, then the learning story goes as follows. Because we have many funds that are first-time funds, right? In our case, neither the VC nor the investor, they actually know the venture capital stability. In our case, new funds have incentive to work hard to establish reputation. So in that case, for younger funds, we should expect lower pay for performance, right? Because you need to allow, you need to tolerate, you need to tolerant, you need to be tolerant for the learning process of these young funds. Right? That's why you want to set a lower pay for performance sensitivity. So for example, for the first fund, if nobody knows the ability, then everyone has the incentive to work hard and discover, demonstrate that ability. Right? In our case, the carry interest and the PPS, the pay performance sensitivity should be low in first time, right? Because reputation is the substitute. Right? For example, they can use, I mean, some kind of leading venture capitalists that have reputation as a guarantee, right? In that case, the LPs might be willing to set a lower PPS. And in our case, variance is also low in first-time funds, right? They should all charge the same amount because you haven't established your reputation, you haven't established your skill yet. And for the second fund, VC ability is partly reviewed through the first fund's performance. And there is a distribution in terms of performance. And in our case, LPs, they need to induce efforts on good VCs, right? And in that case, the good VCs will have higher carry interest, right? The performance fee. And the bad VC are going to get lower carry, right? In that case, in those older funds, then we will see there will be higher variance of the carry interest rate. Right? This is the learning story. We also have the signaling story. Signaling story is like as follows, right? They know their ability, but investors do not, right? And the VCs, they have to signal their true ability to the LPs, right? In our case, new funds should have higher performance sensitivity and a lower base compensation, right? Because high ability VCs, they'll try to review their type by accepting riskier pay, right? This is the high ability VCs, they're trying to differentiate or signal to the LPs they have a high ability by accepting the riskier pay, right? So this is the signaling story. You can see the prediction is actually the opposite from the learning story. Now, if the signaling story goes, then for the first fund, the good VC will signal that they are good by accepting more in carry and the less in fees, right? Because they want to show that they are able to deliver good profits. They are able to take challenge to accept the risky pay. Right? Now, in that case, the median and the bad VCs, they will want higher fees, right? But they won't, I mean, and they will accept the lower PPS, right? Because otherwise they won't make money. So in that case, the prediction is the opposite, right? You have a high variance in carry and the fees for the first fund. Then for the second fund, the good VC will try to recoup the cost he incurred in the first fund by accepting low fees, and then will charge higher fees and reduce the carry. Right? And in that case, the medium and the better VCs, they will still have to accept low fees and low carry, right? Because they cannot differentiate themselves from the good VCs, right? So in that case, in the second fund, you actually should expect low variance in carry because the good VCs need to recoup the cost, right? So that's why they will need to, because they have already proven their success in the first fund. Right? Now they don't have to prove anymore, right? They have to recoup their cost incurred in the first fund. Because remember, in the first round, they are trying so hard to deliver high return. Now the empirical results actually favor the learning model, right? What we find is that the compensation for older and the larger VCs is more sensitive to performance. And the differential here is 1%, right? They're 1% higher compared to other VC groups. And the fixed concomitant compensation is also higher for smaller, younger funds and for funds focusing on high tech and early stage investments. And PPS, the pay performance sensitivity, actually does not predict subsequent performance, right? Implying that investors, they first learn about ability and then adjust compensation to induce efforts. Right? So in general, the empirical evidence actually favors the learning model, where it says that for older funds, the variance of the carry is high. Now we move on to the next part, which we're going to talk about the VC investment decision making. Right? In general, there are 4 parts in that process. First one, it's about screening or deal sourcing. So in that case, this involves strategy identification and quantitative analysis. Right? The second stage is due diligence or deal evaluation. So VCs, they will do some quantitative analysis. They will send out a questionnaire, and also making inquiries. They will also seek expert opinion on the successful on the chances of success for those other firms. And next, VCs will do valuation and risk analysis, right? There will be a detailed quantitative analysis in that process. Finally, the deal will be closed. So in the deal closing process, there will be intensive bargaining, contracting, and funding involved, right? Now, overall, we venture capitalists, because they want to make sure that the startup firms are doing a good job at delivering high return, they have the following tools to do that. For example, conservative valuation diversification, right? And also, they want to conduct systematic screening and due diligence procedure, right? And also, they provide their financing in different stages, because this is the stage in our investment. And also, they do investment in syndicates, right? Meaning that they don't just participate in the fundraising process by their own, right? They will partner with other VCs together, right? And also, during the development of the fundraising process of the startup firm, they will try to provide monitoring service. They will also provide advices, right? They will also try to gain control of the voting rights. They will try to put their experts on the board. They will try to use different financing instruments, and also they will try to provide performance incentive for the CEOs and managers of the startup firms. So first of all, conservative valuation and diversification, right? Because remember, this is a very risky investment. So one easy way to kind of get good returns is try to provide low financing, or provide low kind of price to those startup firms. So the idea is that only a few companies in the VC portfolio need to deliver returns to make up for losses in the others, right? So as long as the VC can price investee companies really cheaply, then you can boost up the overall return. Right? So therefore, VC relies a lot on the sensitivity analysis. So in that case, the valuation of an investee firm should be below the average cash and average, right? Because they want to buy cheap, right? So discount normally applies when comparing investee firm to similar listed firm, right? Because there's a liquidity discount, right? You want to depress the valuation of private firm. Now, if you suppress the valuation of the firm, of course, you don't need that high level of investment. Second, screening process, right? Screening process, there are two approaches. One is the top-down approach. The other is the bottom-up approach, right? For the top-down approach, the VCs, they will try to analyze industry and the markets, right? And they also try to identify opportunity, strategy, and approach firms, right? And this top-down approach is often used by late-stage buyout and generic funds, right? This is the top approach. There's also the bottom-up approach. Bottom-up approach is first you invite screening and you screen proposals. And then you narrow down target firms and then build portfolios, right? Normally, VC firms do that, right? They're also often used by early stage funds and funds with very deep technology focus, right? Because they know the detail. They know the detail of the technology. That's why they want to start from the very beginning. So here are some quotes of the screening strategy, right? How do you screen potential proposals? How do you figure out the potential profitable investments? For example, market potential needs to beat at least 500 million, and the company needs to achieve at least 25% market share. This is kind of the criteria VCs use to screen those promising firms. And also, markets trump people and trump technology, right? And also, for example, it's a sector bet, right? You're just betting on this is a good market. So basically, a rising market will lift all companies in the sector, right? So that's why you want to invest in the right, on the promising sector market. Right? And then next, due diligence, right? Due diligence is basically, it's a process of ensuring information disclosed by entrepreneurs is correct, right? Because entrepreneurs might overstate those information, right, in order to get financing. Now, if you want to do due diligence, then you need to make sure that the information they provided, they are accurate. Right? And in the due diligence process, the DD process, the VCs also need to identify all relevant risk and reduce information asymmetry. And this DD process starts from the screening process, and then it's both quantitative and qualitative. Right? So it's not just like getting the right feel of the businesses, right? It is also trying to get the financial and legal detail of this startup firm. Basically, this process, this due diligence process, is trying to confirm VC investment instincts. Right? For example, the venture capitalists might realize, oh, this is a good sector. Then why not just buy it, right? This technology might be promising. Now, after they pick this startup firm, right, they need to make sure that they're investing in the right target. That's why they need to do this due diligence process. And here's a list of typical due diligence work, right? For example, verify information with expertise, experts' opinion, right? They need to verify information with experts' opinion, right? And they also need to check regulatory backgrounds, right? To make sure that when a company goes on public, when the company is developing new technology, right? What are the relevant regulatory requirements? Right? And also background and credit checks, right? And also questionnaires to entrepreneurs, right? They're trying to identify their attitude towards the risk. Right? I mean, if you get an entrepreneur who's not willing to take lots of risk, then you might not get a high return, right? Because the startup firm might not be able to take those high risky investments. And this process, this amount of work also involves verifying information with previous rounds investors. Right? This verification process is especially important for early stage companies founded by non-professional investors, right? Because they don't know the business well. That's why they need to verify information with previous rounds investors. Right? If you have invested before, the later investors will try to verify information with them. And new round financing often leads to dilution, hence conflicts, right? Because you have a new round of financing, there'll be more money involved, there'll be more investors there. Then
the ownership of each previous investor is diluted. Right? That's why there will be conflicts. And there also will be conflicts of interest or conflicts of purposes between the previous investor and the new investor. Right? Maybe the previous investor want to push for direction X, then the newly joined investor want to push for direction Y. So there will be conflicts there. And in this DD process, you also need to make sure the price paid, the amount invested, and also other terms and conditions. Right? And then you need to also make sure that whether the offer to repurchase earlier round security is necessary. Right? This is also one typical issue you're going to encounter.
So now we go to talk about the staging of investment, right? We know that a kind of distinguishing feature of VC funds, different from the private equity fund, is the VC financing, they come in rounds, right? But for private equity, they just come in bulk, right? So this is typically the feature of the VC financing, that is you have financing in discrete stages of rounds over time. And the shorter the duration, the more frequently the venture capitalist monitors, right? Because if you start a new round, you're gonna be intensive monitoring there. And every time you start a new round, there will be greater need to gather information. Right? If you have more frequent financing rounds, then of course you're gonna collect those information more often. Right? And by doing those monitoring and information gathering, the VCs mitigate those moral hazard and information asymmetry issues here. So the benefits of staging is as follows, right? So first of all, if we're looking at those different stages of financing, one explanation is the VC funds themselves, they receive funding from LPs also in stages, right? Like we previously say, right? LPs, they kind of allocate those commitments in stages, right? They also allocate their financing stages. So that's why the financing from VC also comes in stages. And a second benefit of staging is that it reduces the impact of information asymmetry on the VC, right? So because you have different stages, right? So staged capital, it keeps the owner on the tight leash, right? For example, it's not like I give you 500 million, right? At once, then you spend those 500 million, right? Because if I give you those money at once, I don't have any monitoring. So I have weaker monitoring. I don't know what you're doing. So instead of doing that, I will set 5 stages, right? And then conditional on meeting a certain milestone, then I will give you further financing, right? This is the way to strengthen entrepreneurs' incentives in moving forward, and also making sure entrepreneurs, they are not wasting VC's money, and they're on the right track. Yeah. So, and in the value of the staging here is to help VCs to gather information about the firm and also reduce information asymmetry, right? And also monitor the firm, maintain the option to abandon financing, right? I mean, if you invest 500 million at once, you don't have chance to quit, right? But if you divide it into 5 stages, right, you can exit when you think that the future chance of success is low, right? Then you don't lose a lot, right? So at each stage, the value of the investment in the previous stages, they will be viewed as sunk cost, right? Because they already happened before. I mean, you already commit your investment. Let's just go. You will be just thinking about whether to contribute marginally more or marginally less, right? Starting from this row. So if you do not think that there's sunk cost, then it will lead to the problem of throwing good money after bad, right? I mean, maybe you have previous rounds that the firm is losing money, right? But they are just sunk costs, right? You need to think from now and on, right? Maybe after this round, the firm will start to make money, make profits, right? This is the way you think about whether you want to provide financing for this round or not. And the key variables in the staging strategy include duration and the size of funding per round. And the staging of future finance must be tied to specific variable performance milestone, right? Like I said, the startup firms, they need to make sure that they have reached a certain milestone, right, in order to move forward and get further finance. And this key staging variable, meaning the duration of the stage and also the size of financing, depends on the agency versus monitoring cost trade-off, right? If you think the moral hazard cost and also the agency cost is higher, then probably you want to do more frequent stages. You want to do more frequent stage financing because you want to increase your monitoring more intensively. And of course, if you think that the agency cost of this firm is not that great, then you might want to reduce your monitoring effort. Maybe you want to do less number of runs or less frequent stage financing, right? Because the key thing here is that you can improve your monitoring and you might get some benefits from more frequent stage financing, but the problem is that, I mean, the problem is that this also comes with a cost, right? There's also cost of monitoring. So agency cost consideration include the potential moral hazard, the risk shifting, right? Meaning that the owners of the startup firm actually shifted the risk to those shareholders or investors, right? They may actually doing some projects that are not in the best interest of shareholders. Also, there's a cost of bankruptcy in terms of asset tangibility specificity, right? You want to know the owners of the startup firm, the entrepreneur, is not taking a very, very risky project that might cost the firm to into financial distress or even go bankrupt. Right? And also, the agency costs could be in firm development stages. Right? So the optimal staging basically balances these two things, right? If VC could costlessly monitor, they will continuously infuse capital when needed. So they will do stage financing very, very frequently. Right? For example, instead of dividing the 500 million, they want to invest into the firm into 5 parts. They can cut into 8 parts, 10 stages. Right? In that case, it will be very, very effective. But again, monitoring has the cost, right? Between financing rounds, on average, inside VCs visit the entrepreneur firm once per month and spend 4 to 5 hours at the firm per visit. Right? You have to intensively monitor the firm. So this is the direct cost. You also have the indirect cost, implicit cost, which is the opportunity cost of generating reports for the VC and the entrepreneur. All right. You might also have the opportunity cost of visiting an entrepreneur firm, another firm, right? And also contracting cost, right? Because each financing round, you need to sign contracts, you need to negotiate a contract with the entrepreneur, right? So these are all costs of monitoring that you need to think about. So here are some examples of staging. For example, Federal Express, right? So initially, in the first stage, it's 204.17 share, right? Then after maybe a couple of months, it goes down to 7.34. And then in September, it goes to even lower, right? 0.63 per share. Then finally, in 1978, the initial offer price of the Federal Express on the market is $6 per share. And Apple has 3 stages of financing, right? First one is 0.09, the last one is 0.97. And another strategy VCs use to kind of reduce their cost of monitoring or reduce the, so another way to kind of reduce the risk of each single VC take and also reduce the information asymmetry and agency problem is to have more than one investor in an entrepreneur firm, right? You have multiple VC there. This way you can share the risk at least, right? And also you can share the monitoring task among VC. Now you don't have to incur the cost yourself, right? You can share the monitoring cost among the participating VCs. And also in our case, if you have multiple VCs, you can control the firm board, the entrepreneur's board, right? And you can also control the firm, right? You have greater power in influencing the entrepreneur firm. You can also share the expertise, right? You might have, I mean, suppose you're investing in a high-tech firm, right? You might not have the specific expertise that a firm wants, but another VC might have it, right? So there you can share the expertise. Then another VC's investment target might need the expertise of your funds, right? So then there will be a partnership here. And then by sharing those monitoring tasks, you can improve the information symmetry problem. You can reduce the information symmetry and improve valuation. And this paper by Stan and Stricklis 1986 find that VCs make better decisions about whether to invest when many VC firms agree that an investment is worthwhile. Right? In that case, the chance of success also increases. Right? That's why in general, the prediction here is that a syndicated investment should perform better. Another reason is by Lonko, Nisha, Schlafer, Taylor, and Vishnu. They find that venture capitalists, they collude and overstate the value of the entrepreneur firm upon exit, because they want to sell to a high price. They want to go to IPO and attract investors to buy their shares, right? The prediction is that this indication is also very good because venture capitalists, they have this partnership here. That's why they offer best deals to those that can reciprocate, right? The well-established VC firm. They can run. For example, you participate in my financing, I participate in your financing, right? So this is the reciprocate. And VCs also provide monitoring and advertising, right, through the following ways. So let's look at one by one. For example, they often monitor the portfolio companies by nominating one of the GPs to the board, right? This is to influence or control the firm's progress. And also this allows the VC firm to influence the firm's decisions making and reduce information symmetry, right? And also these VCs, they provide advices, right? Because again, VC, they can have expertise in a specific technological area, right? So they will provide advice regarding strategy and financial matters. So in terms of board membership, the composition of the board is determined by the need to oversight. So when might the firm managers deviate from the firm maximizing decision, right? For example, the firm manager might have their own kind of incentive, right? For example, they might not want to take very risky investment. They might want to just take not very risky investment. So not doing very kind of exploitative, exploration innovation, right? They might just want to stay in the comfort zone. And also, they might have their personal interest, right? They want a firm to be a firm that VCs do not want them to be. For example, they want to push the technology to develop in this way, but VCs want to push it to another way, right? So in that case, if you increase the presence of the VC, in other words, if you want to have VCs, GPs on the board, then this might reduce the likelihood of deviation, right? And especially when a company is in crisis, for example, the CEO of the startup firm left, right? In that case, VCs might get more involved. For example, they might want to try to find another CEO for the startup firms. And VCs also help transform corporate governance from a private firm, like a family-oriented a private firm, whereas there's only one founder who controls the firm, to a more multifaceted system suitable to a listed company, right? So what is a listed company? For a listed company, it has separation of CEO and the chairman roles, right? You have the CEO and the chairman, the CEO and the board chairman, they're separate roles, right? And also, board of directors, they are divided into subcommittees, right? You have compensation committee, you have audit committee, you have corporate governance committee, right? You have different committees that are responsible for different kinds of duties. Also, you have independent auditing, independent directors, right? Independent directors come from outside, right? So that's why they will do a better job in monitoring the firm. And also, VCs will try to push the firm to have regular shareholder meeting, right? To protect the minority interest, the interest of the minority shareholders. Right? So all this is try to restructure the firm to make it more like a firm that can go public later. Right? So research has found that VC-backed IPO have better corporate governance than non-VC-backed IPOs. Right? And the VCs will also provide value-adding services, right? For example, they will provide valuable human resources to the startup firm. Here, it's because VC reputation is an important attraction to potential employees, right? And the VC also has this investee network. They provide a pool of talents, right? For example, I have a talented employee. I have a team that is specialized in like auto car making. Right? In another firm that I invested, right? I can potentially hire those team for my another firm that I also invest in. Right? So this is an internal kind of allocation of those labors. And those VC backing also accelerates the hiring of senior executives, right? Because they have networks, they know people in the industry. And also VCs provide matchmaking, right? They have their network, contacts, reputation, allow the investee firm, the startup firms, to connect to new VCs, right? If they need new VCs in the later rounds of financing, and also to customer, supplier, alliance, acquisition targets, potential acquirers, and investment banks, right? All the potential different parties that this startup firms might need in the process of further development. So finally, we're going to talk about the valuation of startup firms for VC, right? So we know that startup firms, they are not public firms. So it is more difficult, definitely difficult, more difficult than public firm to value, right? And the difficulty essentially lies in four aspects, right? Information asymmetry, right, that we have been talking about. Second, there are many things in the startup firm that are not predictable, right? And also long-term investment, short-term exit, right? The investment in the startup firm is long-term, right? But when you exit, you actually might exit right before your you might actually exit in a period that is shorter than your valuation horizon. And finally, you might have extreme uncertainty during the process of fundraising. So information asymmetry is obvious, right? We have already talked about it, right? So a famous thing by John Keynes said that a share of a stock is worth either what you pay for it or what someone else willing to pay you for it. Right? But if you are thinking about valuing a private firm, then you probably know neither of them, right? Because you don't know how much you pay for it. I mean, you don't know whether you overpaid, you don't know whether you underpaid. Yeah? You also don't know what's the valuation of this company from others' perspective, right? Because nobody is out there paying for a similar company. That's why you cannot find a benchmark. Right? And of course, it's also because the businesses of this startup firm is very unique. Right? You cannot find a comparable kind of benchmark. The second is many of the startup firm, many of the cash flow of the startup firm, they are very uncertain, right? That's why it's very difficult to predict. The difficulty is that the startup firm, they don't have much operating history. They have little or even no operating history. And also they might have no earnings or even no revenue in early years, right? They might have negative earnings. And you might also have research intensive firms, which typically these firms that you have to invest for a couple of years, right? Then you might start to realize revenue, realize profits, right? So therefore, it's very difficult to value. So like even if like for Uber, right? Before it planned to go IPO, Uber has negative earnings for many years, right? Now, if you want to use the discounted cash flow model to value Uber, it's very difficult, right? It might tell you that Uber's value might be negative, right? Because the cash flow is just negative. So that's one example, right? Immediate cash flow is negative. There are also no comparable uncharted territory, right? And also firms seeking venture funds often concentrate in entirely new industry, right? You cannot even find an industry peer because they operate in new industry, new markets, right? You don't know the market by yourself, right? There are also no reliable financial information, right? Because the financial statements provided by the entrepreneur, they are not audited, right? That's why you don't know whether the financial information provided by the entrepreneur is accurate or not. So this makes valuation even more difficult, right? And another reason why it's difficult to value is that firms seeking venture funding for long-term investment, right? They might actually get value at a very early stage, right? Losses in the early stage with startup costs in order to generate growth in the sales over time, right? So in the early stage, you might actually incur many costs. Actually, you might incur many losses. And this value actually is different from what it is when a VC is investing. But because VC investment is long-term, right? But the investors, they require regular returns, right? VCs have to provide regular returns to their investors, even if the success of a VC firm might be long-term. Right? So that's why if you do early exit, that might result in long-term cash flow to be overlooked. Then this might create biases in valuation. And there's also the issue that there's no market to realize investment, right? For example, you want to value a company, right? And then you know the exit, the horizon of the investment or the time the company can go IPO, it's like 10 years, right? But now, in every year of these 10 years, you have to provide returns or provide regular returns to your investor, right? In that case, how are you going to value this company, right? It is very difficult to value this company in this case. Finally, extreme uncertainty. So there's only 1% successful ventures, right? And 6% of there's only 6% of firms who have been receiving venture funding, right? Most of the company, 94% of the firms, they fail and rejected, and they have been rejected from venture capitalists. So you can see the success rate is very small, right? Now in that case, what is the required rate of return? Right? It is very difficult to figure out what is the required rate of return. So the common assumption here is that entrepreneur owners, they're always over-optimistic in their reporting and forecasting. Therefore, you need to, for the VC, they have to do due diligence, right? Also, they have to do sensitivity analysis, right? What if the information provided is wrong, right? If the information overstates the financial condition. Yeah. Also, venture funds, they're unlikely to receive dividends as a form of return, right? The main return comes from capital gains when exiting the investment. That's why determining the terminal value is important. So that's also why you cannot use a DCF model, right? In the DCF model, the cash flow has to come continuously. It's like a dividend, right? And expected return for the investor also differs in different stages. For the seed capital, it's 100%. For the startup round, it's 100%. For the second round, it's 40%. For the third round, it's 30%. For the bridge round to IPO, it's 25%. If it's a distressed firm, it's 50%. For leverage buyout, it's 35%. So now you can see, if you want to value a private firm like a public firm, it's impossible, right? because the expected return, the required return keeps on changing over time. That's why you cannot use a single discount factor to value the firm. So that's why one way to overcome the challenge of valuing a private firm is to get the market's opinion. Basically use the comparable method that we talked about earlier when we talk about merger acquisition. The idea is to try to identify a set of similar companies that are publicly traded to infer the firm value. Right? So this involves multiples and comparable valuation, right? And this you may also need other comparables, right? But basically, the goal is to find firms that are affected by the same economic forces, right? This will be your comparable peers. Right? So if you just compare against industry average, it will be simple and inaccurate, right? Because VC firms, they might operate in new industry, right? So then how to define the industry peer, right? You might not have good industry peers there. Yeah? The businesses the VC firms are doing might be very different from the businesses of existing and old firms. And the task here is try to match the firm, right? Preferably two or more, right? And well, of course, we cannot expect perfect match, right? The goal is to find perfect match, but of course, in reality, we cannot find perfect matches. And also, if we use public listed firm as match the firm, then the multiples might be adjusted to account for the lack of marketability, right? Or liquidity, right? So because public firm and the private firm, they have they're very different in terms of liquidity. Right? The typical discount is like 25% to 30%, right? Because in the public market, your company is more liquid. In a private company, nobody trades your shares, right? That's less liquid. So there we can use the match the firm to establish the lower bounds and the upper bound of share price. And then that tells us how much our initial offer price we want to set, right? If the company wants to go IPO. But one comparable ratio or one kind of multiple is called price earnings ratio, right? We talked about this earlier. This reflects the growth potential of the company. And a related question when you use PE ratio is you can calculate how many years on average does it take to recoup the price paid for the share. Right? This is PE ratio. But PE ratio, of course, has its own problem, right? For example, it's highly inaccurate because the company do not have the price to start from, right? And also it's volatile, right? And also it ignores capital structure and the tax shields of benefit, right? Because if the firm has high benefit, it certainly increase the firm value, but that's not reflecting in the PE ratio, right? Because you're only looking at the equity holder, right? From the equity holder perspective, you might see equity holders' stock actually become more risky, but for a firm as a whole, the value might increase, right? Because of the tax shields. And also when earnings are negative zero, like which happens for many high-tech firms, right? This cannot be used, right? And to eliminate the effect on capital structure, we can have another multiple, which is enterprise value divided by EBITDA. Right? What is enterprise value? It is market value of equity plus book value of debt minus cash balance, right? So this gives you more accurate valuation, right? This also gets rid of the accounting write-offs, right? Which is more, so that's why it's more accurate. And intuitively, this measures the value of the firm's assets, meaning it's the value of the firm's projects relative to the income before payments to the debt holders, right? Because this EBITDA is earnings before interest and tax. Earnings before interest, tax, and depreciation and amortization, right? That's why it's more accurate. Also, there could be revenue-based multiple, right? For example, market value of equity divided by revenue, enterprise value divided by revenue, right? So this avoids the problem associated with earnings, right? What if you have negative earnings, right? Now, if you use revenue as the denominator, that's much better, right? Because you don't have to worry about that.
There also could be book value based multiple, right? Price to book, for example, Tobin's Q, right? Tobin's Q is market value of equity and debt divided by replacement value, right? This tells you the investment opportunity of the firm, basically. And also market to book ratio, MB ratio, right? That reflects the growth option by incorporating the risk. So whether the company has a good growth prospect in the future, right? And this is used extensively in research as well, right? And also another multiple is called market value of equity divided by net tangible assets. Right? This is similar to the market to book ratio, but the emphasis here is on intangible assets. Right? So this is yet another ratio. Finally, how do we select comparable firms? So we follow this list. Same industry, similar business description, similar location in the supply chain, right? They're both customers, for example. Servicing the same market. They have similar sizes, similar revenues, or similar intangible asset intensity, right? And finally, age, right? These are all potential criteria you can use to match the firm you want to do evaluation. Right? Okay, so this is so much for venture capital. And we have a last bit, which is IPO, which we're going to talk about